Did Nike go woke and then go broke?
Back in March, Nike joined a long list of businesses who lost money pandering to a very small but very vocal subset of the population, and boy, did it cost them.
Or did it?
We've seen this before with other companies with varying financial results. Some, like Anheuser-Busch, Bud Light, had a huge impact while others did not.
So what did Nike do that offended the masses so much to boycott them, and how has that affected them financially so far?
Let's get into it.
So here's the deal. Back in March, Nike jumped on the bandwagon doing both a commercial as well as developing a sports bra and leggings. Leggings?
Leggings.
Do it again. Sports bra and leggings for Dylan Mulvaney. And people lost their minds.
The ensuing backlash and outrage boiled over into a cauldron of hate and bigotry that brought such shame and self-loathing to Nike that they changed their marketing campaign 100 degrees for the Olympics.
All right, so what Brian actually meant was that we don't care about any of that. We just wanted to know how it affected them financially, or to see if there was a concern such as Nike trying to sell shoes to people who basically have no feet.
Turns out there is a concern, but not for people who have no feet. What? I told you I'm not letting you write my scripts anymore.
But it's good. It's good.
We listened to the earnings call on October 1st, and these are the things that you ought to know. First, Nike has a brand new CEO, Elliott Hill, replacing the retiring John Donahoe. Elliott comes with a long resume with Nike, so it'd be interesting to see how he performs to take the company to the next level. Expecting a downturn, CFO Matthew Friend said this.
While Q1 revenue was largely in line with our plan 90 days ago, we delivered lower unit sales than we expected, partially offset by a higher ASP. Traffic declines across Nike Direct were more significant than we anticipated. We saw particular softness in traffic on Nike Digital, as well as in our partner stores in Greater China. As a result, retail sales underperformed our plan, including our wholesale partners, with slightly elevating marketplace inventories, requiring higher levels of promotional activity in Q1 to drive conversion. This included the back-to-school period, as our results underperformed the market. We saw store traffic improve in August and growth in factory stores in Q1, but the overall period fell short of our expectations.
With a new CEO incoming, Nike has halted their year guidance and are working on a quarter-to-quarter basis until Elliott can get any programs or processes up and running.
That's not apocalyptic or anything.
No. Second, there was a lot of doom and gloom with the finance. Inventory, operating income, most sales, all are down, sometimes in the double digits. They failed to grow their Nike apps, which I think there's 5 of them, the membership, and move people from the brick and mortar stores to digital sales. They did grow the app by 38% from 0, but was vastly below the 50% that they were trying to hit. Now there's a push to go back to the stores while trying to grow the digital marketplace simultaneously, which I feel is how they should have done it in the first place.
Yeah.
Now, it wasn't all doom, but it is obvious that Nike is in trouble slipping in the market share over the past couple of years. Thirdly, their running department has been a lonely little bright spot where Matthew says this.
We are especially encouraged by the momentum building in our running offense. This has been one of our toughest fights over the past few years, and it is one of our biggest opportunities. Our team's focused here first in driving our comeback. And more recently, men's and women's running footwear delivered positive growth in Q1, a meaningful improvement versus the prior quarter.
Bottom line, Nike needs to get back to the forefront of innovation in the sportswear technology, particularly running and lifestyle lines. Nike is still the majority leader in sportswear and are not in danger of losing that edge, but the current downturn is concerning. There were, of course, a lot of numbers, which Tom will get into. If you need more numbers, let us know in the comments.
So you know I love numbers. I go through all the finances for these companies and Nike. We're going to analyze them as if we were going to buy them as a stock. So looking at the quarterly numbers on their any of the earnings reports you can find in the brokerage, we see that their liabilities had a 4.7 percent increase. Their assets are up, however, only by 3.1%. Moving on to the next page, we're looking at cash flow and income now. The operating income and net income both have decreased by 25%, which they did talk about in the earnings call. With the cash flow, though, we saw that the quarterly loss was 1.375 billion. That's not unexpected with the operating income dropping, but to get a more clear picture of what's actually happening, we decided to also look at it annually. So annual cash flow, in this case, is going to be more representative of what's actually happening. That was positive 2.4 billion in the last year. That does even out the loss they had for the last year, but not the year prior to that. So overall, this paints a picture of a company simply having a bad couple of years post-COVID and via inflation. And for recapping Brian's point, fundamentally, they made a pretty bad mistake by pulling inventory out of their brick and mortar stores to supplement their web business. They should have done that after the web business income superseded their brick and mortar business. This, we feel, is a big contributing factor for the stock performance over the last 5 years and probably why they replaced their CEO.
Sorry, John.
The takeaway for investors, most of the companies who stopped focusing on their business model and instead tried to pander to the cancel culture crowd or politics out of fear ended up paying for it. The same fear that drove Nike into DEI is also now pulling them partially out of it. The lesson? Don't alienate your primary customer base.
As investors, we tend to stay away from singular brands and lean more towards suppliers to many brands because of their ability to sell to a diversified set of customers. This insulates them from having problems like what we're talking about in this very video.
So with this knowledge, what would we be looking at purchasing instead? Well, in this case, we would compare a company like Nike to a textile manufacturer or a supplier of many companies such as MITSY. Kind of like what you would expect to see with DuPont and Gentex are to the automotive industry, something like MITSY or MITSY would be to the textiles industry. So would you add Nike with this knowledge to your portfolio? Do you think we should buy them for a monthly stock purchase? Let us know in the comments below, and hopefully we see you in the next video.
Smell you later, suckers.
What? They got to the end. These are the loyal people. Thank you.
Peace out, brothers and sisters.
We're getting too old.
I'm getting too old for this shit, Marta.
Bye.
Love you.